So let's look at some numbers here and have some fun. What we will begin with is a 40-year-old individual, and we're going to look at just a standard policy loan first. This will allow us to compare exactly what a policy loan looks like to a cash value collateral loan. What we've got here is a 40-year-old individual paying in $100,000 per year for 10 years and nothing thereafter. What we put in this model is the net growth rate, specifically the annual internal rate of return and the average internal rate of return. Remember how we mentioned business owners and real estate investors are really attracted to this? This is what they look at. Real estate investors, business owners, people who are putting in large dollar amounts to these policies always bring this up. What's my net growth rate compared to my net cost to borrow? So first year, I'm paying 100 grand. I've got just about 90% of it, which gives me a negative 10% internal rate of return. I don't care how you slice that. I've got a negative hit right off the bat. One of the biggest drawbacks to whole life insurance is this. No matter how well we design it, we typically have a negative hit right off the bat. Now we continue to max fund it each year. By year 4, we see what's highlighted in yellow, the cash value, $400,000. What this means is by year 4, you've paid in a total of $400,000 and you have $400,000. Now we've got the two IRR columns. The annual IRR represents the total cash value growth minus what you paid in. Just call it the net growth rate for that particular year. So from year 3 to year 4, it grew by just under 2.5%. If it's a non-MEC, we can count that as a tax-free growth rate as well. But that's the yearly growth rate. If we look at this, the average internal rate of return is 0.01%. Why it's 0.01% is over the course of 4 years, I've paid in $400,000 and I have $400,126. So that $126 is where that 0.01% is being generated from. So the average internal rate of return accounts for the early years. What's my average growth rate over a certain period of time? By year 10, for example, I've paid in a total of $1 million. I have $1.18 million, $1,181,000. So my average IRR, 3%. My annualized IRR is 4.08%. So we spent a decent amount of time on the internal rate of return there. The reason why is because people are often asking about that. So I want to make sure that if that's been on your mind, I hit on it. But the reason why is when we look at a model with a direct policy loan, here we go. So here, we're taking a $300,000 policy loan out in year 5. What's the impact of that $300,000 policy loan? Well, the cash value is the equity that determines how much you can borrow, think of it that way. And your death benefit will always be collateralized dollar for dollar. You'll notice a $300K reduction in death benefit in year 5 because I pulled out 300 grand. Now, here's what I want to touch on. Interest rate in this particular example is 6%. 6% cost to borrow goes where? To the insurance company. This is a fixed loan interest rate. So there's the cost to borrow, 6%. There's the loan interest. There's the interest I'm paying out of pocket. And then we apply $30,000 per year toward the principal balance. But 6% cost to borrow, that's what it is. It's fixed, so it'll never change. What's my net internal rate of return? If I look at the annualized internal rate of return, it tops out at 5%, and this is based on the company's present dividend interest rate of 6%. You may know who this company is now, but that's okay. So, annualized IRR 5%, cost to borrow 6%. If I look at my average internal rate of return, do I ever hit 6%? No, I top out right around 4.6%. So, do I have a positive spread or negative spread? It's negative when I look at it. Now, again, some people are okay with this because they view it, hey, I'm still earning an attractive rate in the policy on my entire cash value. I'm only paying the 6% on the amount I take a loan out. So therefore, I'm technically still compounding a greater dollar amount than what I'm paying in loan interest. But some look at it and say, hey, I've got a higher cost to borrow, like, it's not for me. What's an alternative? Otherwise, I'm not going to do it. So let's look at an alternative here. Same policy here. We've got the funding for 10 years on the left, and then we've got our cash value collateral loan workbook. So what I want to do first here is just plug in the loan to value, because it's typically 95%. So what we've got here, this will be pretty easy to follow, is just 95% of whatever the total cash value is. So for example, year 10, you've got $1,181,000 in cash value. 95% of that is the $1,122,000. So as we look at this guy, make this a click bigger. There we go. If you want to now leverage the policy, what did we take out in the last model? It was year 5, a $300,000 loan. So if we want to do that, let's plug in a $300,000 loan in year 5. And there we go. So what this does, we've got a cost to borrow over here, 3%. This would go to the bank in this particular case. So if I just pay interest only, I have this $9,000 annual interest expense. However, let's take a look at this. Under our loan repayment, let's assume the next year, let's assume 1 year actually we don't make any principal payments, and then begin to repay it at $30,000 per year toward the principal. So with this model, just how I'm building it out, we're paying more than $30,000 net out of pocket because we are covering the interest payment and then $30,000 on top of it. The column on the far right, net interest, what this represents is your total interest payments. I found a lot of people appreciate seeing this. I do myself because sometimes it can be difficult to calculate when I've got all of these numbers and columns. If we just lay it out there, it makes it easier. So for example, interest payment here, the year I take that $300,000 loan, $9,000. That goes to the bank. So we have the net interest payments over here of $9,000. Over 1 year, that's the total amount of interest I've paid to the bank. Now in the second year, I make a $30,000 principal payment, $8,100 in loan interest. That $8,100 is 3% of the $270. Now we've got the net interest over here, $17,100. That combines the total interest payments I've made over all years, in this case, the first and second year. As we continue to pay it back, there we go. I have paid a total of $49,500 in interest to the bank. With real estate investors that we work with, this is the kind of stuff we like to walk them through or go through this model. I send this workbook. We all do. When I say we all do, our agents will send it. If you're working with us, we'll send it to you, no problem. But we like to see what will the actual cost be. It's a very simple workbook to use. So if you have it, you can easily just plug in numbers just to get an estimate of what your costs will be. It's neat to see this stuff in advance rather than just hoping things will work out. You know what I mean? So here we go. With the net cost to borrow, 3%. This is good. And then do the same thing over here. What's my annual IRR and my average IRR? Annually, by year 5, based on the company's present dividend rate and the design of this policy, I'm earning more than what I'm paying in loan interest, assuming the variable rate does not go up. On the average IRR, year 5, I'm at a 1% net positive return. So that's a negative 2% spread. If I look at the average, when I look at the average, I like to look at it, and a lot of people do, but the average IRR, that's 1% on your total bucket of money, the $515,000, where you've paid in $500. Versus over here, I've got the 3% only on the $300,000. So it's good to look at both. Hopefully this does provide some value as we continue to go through it. When I look at the average IRR over here, year 10 is where I exceed 3%. So again, it's good to look at both. Again, I'm a fan of the annual because I get to see what am I paying in loan interest that particular year and what am I earning that particular year. Let's look at one more example here of someone we work with that I like very much, who is 52 years old, female, that's using her policy for real estate. She can elect to borrow directly against her policy at a 5% cost to borrow which isn't bad, that's right around the average, or a cash value collateral loan. She was actually in a position where she started the policy. It was a little bit different dollar amount than this, but she started it and said, hey, I've got an opportunity. I'd like to take out about $100,000. We looked at a direct policy loan, then also a cash value collateral loan. She actually was able to postpone the date of the transaction to take advantage of a cash value collateral loan, just because after looking at the cost to borrow, more comfort was there, cheaper. It's like, hey, I'd much rather go this route. So let's plug in the numbers. What I also want to mention here too, and awareness is key here, because if I take a loan in the first policy year, if I don't take a loan, I have a negative 16% hit in this particular example. If I take a loan, whether it's a direct policy loan or cash value collateral loan, now I'm paying interest on the dollar amount to the lender as well. So it's kind of like a double whammy where I'm inflicting myself with more financial pain in the first year if I isolate that first year. I'm not beating up the product I sell. I'm just trying to provide the drawbacks. This way I've got full transparency. I don't think that I'm getting the best thing in the world, something that's better than sliced bread, only to find out after the fact that the bread has mold on it. I don't want to eat moldy bread. So just having awareness, and I appreciate when someone says, hey, here's a drawback with the strategy you're looking at. And if I look at it and say, I'm okay with that, because I understand that I recapture everything long-term, because once a dollar passes through the cash value of a life insurance policy, it is forever at work for me. So let's look at the loan scenario. She wants to take $1 million out. Year 5 in this example was $100,000 in year 1. Why don't we actually do what she did? $100,000. I'm sorry. First, let's do the loan to value ratio, which would be this times 0.95. There we go. Okay, so let's look at a collateral loan in the first year, which you can take these cash value collateral loans anytime you want. It can be within the first month of starting a policy, first 10 days. So again, make sure we're always accounting for that negative IRR up front, but at the same time, there's no time frame or restriction that says you must wait 1 year before you can look at these. Some banks do have a 1-year waiting period. I will add that. Most do not though. We have not run into that problem with any of the lenders we work with or recommend. And for transparency, when I say we work with lenders, for full awareness, in case you're wondering, our company, or myself included, do not have any kind of financial relationship with the lenders we work with. I simply refer to the lenders that I trust the most, that make things most convenient for the consumer at the end of the day. Are things easier, and is it the best rate the consumer can attain? So here we go, a $100,000 loan. $100,000 balance at 3%, that's $3,000. This model assumes paying interest only. Look at the far right. It's going to tally up your total cost to borrow over time, or total interest costs. Let's look to pay this back. If she pays it back at $2,000 a month, in addition to the interest payments, here we go. Now with this workbook, what you actually have to do here, so I've got a balance left over of $4,000. If I plug in 24K again, it goes negative. So I got to make a couple tweaks in the workbook, or I can just pay off the remaining amount, $4,000. So there we go, $2,000 per month. She pays it off in a little over 4 years, and there are the total interest expenses. We can model any type of loan we want, and we've got the total amount we can gauge with respect to how much you can borrow out. Nothing fancy here with the workbook, but it is fun to use. So a lot of info there. I hope you enjoyed it. If you have any questions, please feel free to reach out anytime. If you already have a policy with us, or if you're interested just in talking about it, feel free to email us, call us direct. We're always happy to talk. If you did enjoy the video, please hit the like button. Subscribe for more, and as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.